Good morning and welcome to today's Premium Account Investor Signals Market Update for October. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Investor Signals, have over 17 years of experience in the financial services industry as a licensed securities advisor. The topics for today's presentation, it's a quick summary of the macro update driving equity valuations. We roll through the ASX top 50 stocks with a particular focus today on the current dividend yield given the 10% market correction we've had, and also the 2015 portfolio strategy, and we conclude with a short-term market outlook. The Investor Signal service is centred around a premium account service which is based on a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates to generate above average cash flow while still delivering capital growth. It's managed under a strict investment mandate suitable for self-managed super funds, and the assets remain in your name. If you'd like to know more about our service, please contact me, Leon at investorsignals.com. Okay, moving straight into a graph of the US market at the moment. And in the September market outlook, so roughly 4 weeks back, I'd highlighted that in particular the Australian equity market was due for a correction. We really haven't seen much of that reflected in the US market, and that's predominantly because the bulk of the selling in our domestic market has been a result of Aussie dollar weakness. From the US market's perspective, it's still trading at about 16.5 times forward earnings, pricing in about 8 to 10% earnings growth over the next 12 months. It'll be interesting to look at the October earnings numbers as they start, or the September quarter numbers, which come out in the first week of October, to see whether the S&P 500 companies are having their earnings impacted by a slowdown in Japan during sort of that June quarter and arguably still into September, the weakness in China, and the obvious weakness in Europe. One would think that a combination of those things and a slightly higher US dollar would start to chip away at those offshore earnings of the S&P 500 companies. So look, in saying that, balance sheets are very robust and central banks are really providing significant support to equity markets. So I don't think sort of there's a reason to be negative on equities. I think the probability is we may get a period of consolidation, but on balance, equity markets will probably continue to grind higher, or again, maybe as a minimum move sideways. The domestic market's a different story, and let's look at the main reason why that is so. The Aussie dollar, so the real shift here from sort of 95 cents down to 87 just over the course of the last 3 months, but the sell-off that's occurred over the last sort of 4 to 6 weeks, what that does is obviously any offshore money that's sitting in the Australian market, if the view is that the Aussie dollar's moving lower, maybe down to 78 cents, for instance, 75 cents, there's obviously a tendency to cash out of Australian equities. Combine that with the low iron ore prices, problems in China, and average earnings growth here in our domestic economy, some viewing that the housing market's overheated. All those things add to maybe a little bit of uncertainty that's helped offshore investors to take profit out of the Australian market. There's some individual stock issues which I'll talk about as we roll through the top 50 companies. I actually think we're now getting pretty close to a point where value's emerging. Back in the September recording, I highlighted that we were shifting to cash. We started to trim profits on a good section of client portfolios, expecting the market to correct 10%. We've really now done that. Where it bounces, maybe it moves down to 51, 50 thereabouts, but I think ultimately we're getting now down to a level where buying will come in, and what I'm looking for is a market to rally back up to possibly even as high as sort of 54 to 5500 before we really have another look at what the next strategy is. But where there's value in the top 50 stocks, we start to sort of pick that off at the moment. So let's have a look at where we see that. AGK, continue to like this name. Obviously they've just completed their rights issue. That was at a deep discount at $11. That's to fund the acquisition of the Macquarie Generation assets there in New South Wales. I think at this level, AGK still looks okay value, trading at about 14 times forward earnings on a 4.75% yield. Looking for it to find support, gradually trading back up to around that $14.50 level. From a dividend yield standpoint, AGK pays out about 64 cents per annum in dividends. Asiano, always a little bit cautious around this one. I didn't think the earnings result was particularly good. It was really about cost cutting and the rally in the share prices and increase in the dividend payout ratio. On forward earnings, the market's still looking for about 10% earnings growth, so I put a bit of a question mark over that, but the stock trades on about a 3% dividend yield, about 14 times earnings. You can see where I may be happy to start to take a look at it on a pullback to around that 580 level. Amcor, this was a great standout result within earnings season. They delivered about 8 to 10% underlying earnings growth. A lot of offshore exposure here, so predominantly sort of US dollar earnings. Although they don't report that in Aussie dollars anymore, their earnings results are reported in US dollars. Still, from an earnings or dividend payout perspective, I think the stock trades on a forward PE reasonably expensive, about 17 times earnings on a 4% dividend yield. So the argument for a lot of upside from here is probably quite limited, but I do think Amcor can continue to grow high single-digit earnings over the next sort of 2 to 5 years, and I think this probably uptrend has a lot further to run. Over the next 6 months, maybe it's sort of sitting up at, close to resistance. Our strategy here is that we're still comfortable owning it, but you need to be selling fairly tight covered calls. So a combination of the dividend and the covered call, we're driving about 10 to 12% cash flow out of Amcor. So even if it does bump sideways, that's a suitable return and a fairly defensive addition to portfolios. AMP, I'll come back to this one in another recording. I think, yes, there were some signs of positivity in the earnings result, but we're not doing anything there at the moment. ANZ, so in most cases where we were trimming profit on client accounts, we got out of ANZ around this $33 level. Shifted into Sonic as a main rotation there, but around this level I think ANZ starts to look okay again, so around this sort of 30.50 to 29.50 I'd expect it to find support and rally back up. From a structural perspective, we'll have a look at sort of whether the lower high that I'm thinking will occur in markets over the next month or two is an opportunity to take cash off the table or profits off the table again, or whether it will ultimately be a sort of consolidation and a move higher, but that's for next month's recording. But ANZ at these levels trades at about a 6% dividend yield. My only caution here on ANZ is are we clear on what troubled loan exposure they have in their Asian business, and for that reason my preference is to probably avoid ANZ and look at Westpac and CBA as our preferred banks at present. APA, I'll cover that in next month's recording. ASX, so we continue to like this. I think this is a name that makes sense to have in portfolios, a little like Amcor. It's priced at the top end of the range, looking for about 5% earnings growth into 2015, which is roughly similar to what they delivered in 14. The stock's on a 5 and a bit % dividend yield, trading about 17 times earnings. Market volumes are a little bit thin. ASX are pushing into new products to drive revenue. I think at these levels it's okay to own it, but again, you need the covered call driving that sort of combination of the call premium dividend yield up to around 10 to 12% justifies holding it while it moves sideways. AZJ, now we've been waiting for this to pull back. You can see there that I've marked a high conviction. I think that the market's been a little cautious on AZJ as a result of an earnings result that missed expectations, but as I'd always highlighted, it was never going to deliver 20% earnings growth. They came in at around 13%. I think AZJ, if it can deliver 10% earnings growth over the next 12 months, which will come from a fairly disciplined approach to their cost line, but ultimately down here at around this 450 level, I think the stock's good value, and I think it bounces back up towards $4.80. BHP, again, good value down here. I think this is a name that makes sense to hold it. Iron ore at 77 a tonne. I think we're getting close to sort of the bottom of that sell-off. But really, BHP is increasingly a story about energy, like so petroleum and shale gas exploration in the US and Mexico. I think that the upcoming spin-off of Newco will obviously unlock some value. So for the strategy here, if we're going to have any exposure to resources, I still think it's limited to BHP. From a valuation standpoint, the stock's on about a 3.5% dividend yield, trading about 13 times earnings. It'll be interesting to see if we don't get a rally in iron ore prices, we're probably looking at somewhere around 15% earnings downgrade to 2015 numbers for BHP. But I think the market will look past that because of the upcoming spin-off of Newco and the separation and the value that's likely to unlock for shareholders. Brambles, this was a good earnings result here. Again, one of the beneficiaries of a low Aussie dollar, so a lot of US dollar earnings here that look attractive when they're converted back into Aussie dollars. The stock's expensive, trading at 22 times next year's earnings, trading about a 2.8% dividend yield. So it's no surprise that it ran into resistance. I've always been of the view that at around $9.50, you've got to look at selling the covered calls up at around $9.75 to $10. I think it consolidates and moves sideways, but I do think eventually Brambles will break out of this range and probably towards the middle of next year trade between sort of $10 to $11 range. So we continue to want to have exposure to Brambles in portfolios. CBA, I think down here it's starting to look attractive. I think this sort of fits in with our theme that I think the market's ready to have a bounce. I think the sort of offshore selling in the Aussie dollar, the weakness in the banks as a result of policy change coming through from the RBA to take the heat out of the property market. I think we haven't seen selling in the equity markets for a while, so a lot of super funds that have enjoyed seeing share prices pretty much do only one thing and rise. As soon as you get a little bit of sell-off, it's expected to have some level of panic. I think down here, though, we find support and CBA bounces and moves a little bit higher. Coca-Cola, look, on forward earnings, assuming that they keep their dividend policy, it puts it on about a 5% dividend yield. Still of the view, you can see there that I've marked that it's value. Looking for sort of further commentary out of the company on some type of turnaround strategy there, or in particular cost-cutting program. Computer shares held up well, again a beneficiary of a low Aussie dollar. From a valuation standpoint, the stock's expensive, about 19 times earnings on a 2.5% dividend yield. Should grow earnings maybe somewhere to 5 to 10%. CSL was a great earnings result, 10% underlying earnings growth, a further $900 million share buyback. But from a valuation standpoint, trading 26 times current earnings, 24 times forward earnings on a 1.7% dividend yield. I think it's due for consolidation. Crown, I think this is now down at a level that is worth starting to have a look at. I think at around sort of this 13.50 we'll probably get a bounce back up to around 14.50. Obviously it's a slightly higher risk investment exposure, so it doesn't make up a large allocation to portfolios, but it certainly comes onto the radar down at these levels. Dexus not doing it there at present, nor in Fortescue. Goodman Group within the property trust, I think this is one of the best quality property plays. It's unfortunate there's no call options that we can run over this name, but on roughly a 14 times earnings and a 4.27% dividend, it's starting to look attractive. Up here when I said that the stock was compressing below sort of 4% and it's ready for a correction, I think we're seeing that consistently in the market with names with sort of low single digit earnings growth. When the yield compresses anything below 4%, the market's recorrecting. So I think the fair value for this is back here at around $5. I don't know that there's necessarily a huge amount of upside short term, but at or near $5 the stock starts to look good value. GPT at or near this level here around $3.80, I think it's good value. Growing earnings somewhere around sort of 3%, so disappointed markets a little bit. But owning it at or near these levels, selling the $4.10 covered call, we're driving sort of roughly 10 to 12% cash flow out of GPT, and I think it's a fairly defensive mix to portfolios again. IAG back at around sort of 570, happy to take a look there, not doing anything lucre at present. IPL sold off in line with all the commodities, so as the US dollar effectively rallied and we've seen the rest of the currency markets essentially move lower, you've seen commodity prices move lower in tandem to that higher US dollar, so DAP prices have been caught up with that. That's impacted forward earnings outlook for IPL. But again, I think when you look at what's happening there in the US dollar and the treasuries are pulling back below 2.5% in the US. I think that signals that probably this US dollar strength has run its course. I think that takes the pressure off the Aussie dollar. We see that move higher and we get a bounce in commodities. I think IPL's still pretty close to sort of attractive valuation here, so looking for it to bounce from this 270 level. James Hardie, I think, interesting down here at these levels, but not making up a core allocation of portfolios. Lendlease, we find this business very attractive, but you are paying a substantial premium for it at the moment. Even allowing for about 10% earnings growth into 2015, the stock trades on about 14 times earnings and a 3.5% dividend yield. So we're keen to keep exposure to Lendlease, but we'd certainly like the opportunity to pick it up at a cheaper price. So Mirvac delivered an okay earnings result, again around 3% earnings growth. Stocks trades about 14.5 times forward earnings, and that's allowing for sort of pretty flat growth over the next 12 months on about a 5.5% dividend yield. I think it finds support here, but I don't think there's a real strong case to say it rallies strongly. And I might just flag also that that was one of those names that in the prior recording I highlighted that it was unlikely to really trend too much higher from there. Macquarie, so interesting that Macquarie's came out over the last sort of 10 days and reaffirmed that they expect FY15 earnings to meet or slightly exceed last year's earnings. That puts the stock on forward earnings of about 14.5 times and a 5.4% dividend yield. The market's still pricing in roughly around 20% earnings growth. That supports the current valuation. Can the company deliver a further 10 to 20% into sort of 2016? I think it's far too early to really make a bet on that. I think the probability is that it consolidates, but again, not making up a big part of portfolios. So NAB, our preference is really CBA and Westpac, but broadly the strategy's the same here, that I think the Australian equity market's probably getting close to being ready for a bounce. I think we get some level of consolidation at or near this level, and we see it trend a little bit higher. Newcrest, we see gold started to sort of trend a little bit higher over the last few days. And I think the story with Newcrest, good production numbers, about $130 million of free cash flow, but really requires gold to trade up to around sort of 1,400 an ounce to really start to see Newcrest kick on from here. There is some talk in the market about them spinning off their Lihir assets and separating them into effectively sort of a good Newcrest, bad Newcrest type structure. They are one of the lowest cost gold producers in the world, so still comfortable to have some exposure there to Newcrest. Origin, this is one of those names that we own at lower levels. We've sold the covered calls on it. I think we've probably done the right thing there with that. We're driving around 10% cash flow out of holding Origin. The stock trades about 20 times forward earnings on a 3.5% dividend yield. As we get into the back half of 2015, I think we're likely to see shareholders rewarded with increased dividend payout from Origin. But at or near sort of this $14 level, I think on a pullback it starts to look attractive again, comfortable with Origin. Not doing there in Orica. Oil Search, I think this sits on the high conviction list, somewhere back here at around 874. I think we're strong buyers of Oil Search. We're seeing good shipping and production numbers coming through from their Papua New Guinea assets, and that's going to flow through to higher dividends to shareholders over the next 12 to 36 months. QBE not doing there at present. Ramsay Healthcare, great business, just very expensive up at these levels. And just to put some numbers on that, it trades about 25 times forward earnings on a 2% dividend yield, and that's allowing for about 20% earnings growth. So price to perfection there with Ramsay. Rio not doing here at the present. Our preference is BHP, but to give you some numbers on it, it trades about 11 times forward earnings on a 4% dividend yield. I think given our view that iron ore pretty close to support here at 77 a tonne, Rio should start to find some level of support here. And finally, with Scentre Group, we largely started to trim profits in Scentre Group. I think back here at around 320, 330, it's sort of fair value. The stock effectively trades on about a 5.5% dividend yield at those levels, so I think it consolidates and moves sideways around there. Stockland's one of our preferred property play exposures, so they delivered around about 7% earnings growth in 2014. I think the expectation is that they can deliver something around 5 to 7% again in 2015. From a technical perspective, you can see one of the patterns that we look for from a bullish technical perspective is sort of a higher high, higher low, seeing the accumulation come in at that point. I think at around this $3.80 level here, the stock finds support. I don't think it can push too much above 410, so we've largely sold covered calls at around that 410 level, again turning sort of what would normally be a 5 or 5.5% dividend yield into around about a 10 or 12% cash flow, and I think we're likely to see Stocklands move sideways. And I really think, we're in an environment where the covered call strategy really starts to add value to portfolios, as a lot of these names are trading on high multiples, limited earnings growth, and I think in a backdrop where the Aussie dollar remains weak and there continues to be at the margin offshore selling, I think there's a strong argument that you want to be running a covered call strategy over Australian equity portfolios to enhance that income and continue to drive returns in what will probably be a reasonably flat market for the next 6 months. Sonic Healthcare, so this was one of our rotations. We got out of ANZ into Sonic, and I think that's been the right move. The stock's rallied from around 1650 up to 1750. Any push a little bit higher, we'll take that as an opportunity to sell the covered calls up at around $18 to $18.50, again delivering around 10 to 12% cash flow, and it's a good defensive asset in portfolios. The company will grow earnings about 5% over 2015. Santos, as with Origin, Woodside Petroleum, I think they're pulling back in the value range. I think these names, the oil and gas names and the banking stocks, are now starting to present some value, along with a couple of those names like AZJ, Crown, on the peripheral that also sort of add to portfolio returns. But certainly Santos down here at around $13.50, I think it's a buy. We own it at lower levels. When the stock rallied, we've sold the covered calls up at around $15, so we're sitting at a safe level there, and again we've turned sort of that low dividend yielding stock into something that's driving around 10% cash flow, and we've still got the opportunity for capital gains there if the stock was to rally back up towards that $15 level. For new money coming into the market, it's worth keeping that one on your watch list around this $13.50 level. Suncorp, not doing there at present. Sydney Airports, I think this is back on the radar after not looking at this one for a long time. I think it's somewhere around this $4 to even $4.25. I think it's okay to own it, sell a tight covered call, and drive that cash flow up to 10%. Transurban back here at around this $7.50 starts to look okay. We've seen a slight downgrade to the debt rating of Transurban, which was really what was responsible for this hit. Maybe a little bit of offshore yield selling as well, but around this $7.50, I think Transurban starts to look okay, puts it on a 5% forward dividend yield, and I think we're likely to see the company continue to increase their dividends. They're likely to pay out about 39 cents to 40 cents in 2015. Telstra at these levels is back on a 5.85% dividend yield, trading about 15.5 times earnings. I think here it finds support. This fits in with our view that the banks, oil and gas, Telstra, again a couple of those peripheral names that I mentioned, all start to look okay to be added back into portfolios at present. Toll Holdings surprised the market with their earnings result. The market had a pretty low expectations with that earnings result. The company delivered about 5% underlying earnings growth. Some of that was delivered through cost cutting. I think here the stock's pretty full value. It's on a 5% dividend yield, about 14 times earnings. Happy to own it, and we do at lower levels. We've sold the covered calls here at around $5.75. We got around 25 cents for that, so it's effectively giving us an extra price here of $6. If the stock bounces sideways below that $6 level, or $5.75 level I should say, we're turning that 5% dividend yield into about 10 to 12% cash flow from the dividend and the call premium. Westpac, we're buyers of this down here at around this $29 to $30 level, or really say $30 level. We're buyers, and that fits in with that broader view on the market. Wesfarmers, just to put some numbers on this, because Wesfarmers and Woolworths have historically been expensive. We've seen them sort of pull back a little bit over the course of this sell-off. Puts Wesfarmers on a forward earnings of about 5.3%, still trading about 19 times earnings, and that's allowing for about around 5% earnings growth. So the forward expectations for Wesfarmers are starting to moderate, and I think that probably fits in with sort of our view that around this $41 to $42 level is the buy range for Wesfarmers, and really at any time the stock's been sort of sitting up at around this 43.50 level. We've been selling the $44 calls. In a lot of cases we generated almost $1 of premium for that, so effectively giving us an exit up here at around $45. Again, that's in the event that the stock rallies, it allows for some capital gain, but in all probability it moves sideways and we turn that 5% dividend yield into sort of 10% cash flow. Westfield, this is our absolute preferred property exposure play. I think over the next 5 years, Westfield unlocks value for shareholders. Down here at around $7.50 is a buy for us. But again, it is expensive. It trades on a forward yield of around 3.9%. But again, I do think, taking a longer term view, 3 to 5 years, it represents very good value where it sits at present. Woolworths down here, again, fitting with the broader view of the market, I think it represents value. We want to be sort of adding exposure to Woolworths. The stock trades 16 times earnings on a 4.25% dividend yield, whether it's at $34 or $33.50, but ultimately I think it finds support here and moves a little bit higher. Woodside Petroleum fitting in with our oil and gas sort of recovery play. I think somewhere below sort of $40, it makes sense to add exposure to Woodside. It fits in with this technical pattern that we're watching for higher highs, higher lows. So I'm actually just going to shift that up a little there. And I think that's sort of the range there where we want to start taking a look at adding exposure to Woodside. From a forward earnings or dividend yields, first of all, it'll pay out about $2.34 in dividends, so reasonably flat compared to last year. The underlying earnings growth in the business, again, the forward earnings growth is probably likely to be somewhere in the order of earnings per share wise, just under $3 a share, so not looking for too much in the way of earnings growth. But down here, as the stock sort of gets back to a 6% dividend yield, I think it starts to look attractive. I think the market will have another run for yield coming into from probably December through till January, and what we're trying to do now is sort of position some exposure, but also keeping in mind that we're cautious of whether the market puts in a lower high after it rallies off this low. But in the case of Woodside, happy to add that to portfolios. So here we are back at the top 50 index. So I'll just focus on this a little, because in the September recording there was exactly when I said time to take profit, and we were very fortunate that we started to trim portfolios only days before this sell-off occurred. So we've got a bit of cash sitting on the sideline at the moment. I think there's no rush to get that back into the market. I think that the pattern probably is that US earnings often get off to an okay start, and then there's a little bit of selling towards the back end of the September earnings results is our expectation. I think in that environment, hard to get an exact timing on it, but I think the type of pattern that we look to unfold in the Australian equity market is some buying to come in, a rally back up, and at the top of that rally, I think it would be a reason for caution. So if we find that the market sort of moves maybe down a smidgen from where it is at the moment, but we gradually start to recover towards that sort of November, and then whether we get a sort of further sell-off, I'll update you on that when I prepare the November recording. But right at the moment, it's really about identifying those defensive assets, keeping exposure to the US dollar earners, Amcor, Brambles, selling tight covered calls over those names. Within the Australian property play, your Westfield, Stocklands we continue to like. Most of the portfolio we've already capped the covered calls on, so we're driving that extra income from the dividends and the call premium, providing a little bit of defensiveness to portfolios and downside protection from that added call premium. And we're sitting on reasonably high levels of cash at the moment compared to being fully invested for the last number of years. We now find ourselves sitting on anywhere from 10 to 30% cash, so we start to sort of pick off opportunities in the weeks ahead, utilising some of that cash. Thank you for listening in, and if you'd like to know more about the Investor Signal service and how we can work in partnership with you to manage your account, please contact me using the details on screen.